Financial Analysis from A to Z Episode 3. Let's turn the raw figures into ratios and learn to judge profitability, liquidity, and solvency at a glance. A single figure says nothing. But a ratio sets two quantities against each other and reveals what a raw amount hides. It finally lets you compare two companies of different sizes. Let's put DistribPlus under the microscope. On the agenda, the four families of ratios. Profitability, with ROE and ROCE, liquidity, the ability to pay on time. Solvency, lasting over time. And turnover, with debtor and creditor days. Chapter 1. The four families of ratios, one for each big financial question. A ratio sets one quantity against another, a profit against capital, a debt against equity. Its value, it neutralizes the size of the business and makes two very different companies finally comparable. For families, for questions. Profitability, does the firm earn enough? Liquidity, can it pay its short-term bills? Solvency, will it last over time? And turnover, does its operating cycle spin fast enough? The absolute rule with ratios, always compare. An isolated ratio is mute. You compare it with three references: the firm's own history, the sector average, and direct competitors. The gap talks, never the value alone. The trap of the raw figure. 1 million of profit is excellent for an SME with 5 million of sales, but mediocre for a group at 100 million. The ratio profit to sales settles it at once. Chapter 2. Profitability, profit set against the capital that made it possible. The first profitability ratio, return on equity. It sets net profit against equity. It answers the shareholder's question, what does each pound invested return? A persistently low ROE deters any fresh capital. The second, return on capital employed. It sets operating profit against capital employed, debt included. It judges the asset base itself, regardless of financing. Against the cost of debt, it says whether borrowing creates value or destroys it. The profitability of DistribPlus in figures. ROE falls from 21 to 13%, 8 points lost in 1 year. ROCE is now only 8%, dangerously near the cost of debt. The warning is serious. At DistribPlus, every profitability light dims. ROE drops from 21 to 13%. ROCE falls from 11 to 8%. Net margin contracts. 3 ratios, 1 diagnosis, the firm rewards its capital less well. To understand a ROE, you break it down, that is the DuPont breakdown. 3 levers, the margin, the asset turnover, and the financial leverage. This reading says why profitability rises or falls, not just by how much it moves. Leverage is a double-edged sword. As long as ROCE beats the cost of debt, borrowing amplifies ROE. But at DistribPlus, ROCE falls to 8%, close to the borrowing rate. The lever turns against the shareholder. Reading profitability well. Tell return on equity from return on capital employed. Compare ROCE with the cost of debt. Break down ROE to find the cause. And always read the margin alongside the asset turnover. Chapter 3. Liquidity and solvency, paying tomorrow and lasting 10 years. For the short term, the current ratio. It sets current assets against current liabilities. Above 1, the firm covers its near bills with what is coming in. Below 1, a cash squeeze threatens. For the long term, the equity ratio. It sets equity against total assets. The higher it is, the less the firm depends on the banks. It is the cushion that decides survival against a lasting shock. A third structure ratio, gearing. It sets net debt against equity. Above 1, the firm owes the banks more than its own shareholders. This is the ratio lenders watch very closely before granting a facility. Good news for DistribPlus, its structure holds. The current ratio is above 1. The equity ratio reaches 43%, well above the prudent threshold. Gearing stays under 1. The underlying strength offsets, for now, the falling profitability. A method rule, echoed by the Bank of England. Analysis never judges on a single ratio. It is the convergence of the three families, profitability, liquidity, and solvency, that founds a real financial diagnosis. The reprieve of DistribPlus. Its structure still holds, thanks to equity accumulated over the years. But if profitability keeps melting, these reserves will erode. Today's strength is a reprieve, not a lasting guarantee. Chapter 4. Turnover and days, the speed at which the operating cycle spins. First measure, debtor days. It measures in days the average time to collect invoices. Each day saved frees cash. A lengthening figure is often the very first sign of a difficulty. Two more indicators, stock turnover, which says how many times a year the stock renews, and creditor days, which measure the supplier credit obtained. The balance between these 3 days drives the whole working capital. Here are the days at DistribPlus. Debtor days rise from 18 to 26, cash comes in more slowly. Stock turns in 42 days. Suppliers grant 55 days. The mismatch explains the tight cash despite the profit. The ratio the bank looks at first, net debt to EBITDA. It sets net debt against EBITDA, in how many years the firm would repay its debt with its yearly cash. Above 3 or 4 years, the bank turns cautious. Steering the days. Cutting debtor days frees cash immediately. Speeding up stock turnover eases working capital. Negotiating creditor days funds the cycle. And track the three together, never one alone. Chapter 5. The misreadings of ratios and everything ActioFin gives you. 3 traps on ratios. Reading a ratio alone with no sector or history. Mixing benchmarks by comparing with a different sector. And forgetting the overall coherence, because crossing the families is what truly enlightens the diagnosis. All of ActioFin for your ratios. The complete, free course, chaptered like this series. The ratio calculator, profitability, liquidity, and structure. The workshop to compute them on a real set of accounts. And solver to interpret a ratio. 2 levels on ActioFin. The free one, to learn, with the chaptered courses and the ratio calculator. And to go further, solver, which interprets your ratios with sources, and the workshop for a guided financial diagnosis. 3rd episode done. You can now judge a company on its profitability, liquidity, and solvency ratios. Find the free course and the ratio calculator on ActioFin. In episode 4 we follow the money, working capital and cash. Put these ratios to work on ActioFin.com. Subscribe, and see you soon.